Welcome back to the deep dive. If you've been tracking the tech sector at all over the last year, you know the single biggest story is AI, and just this undeniable, almost feverish excitement around the stocks driving it.
That's absolutely right. And, no company really embodies that high-flying hype better than Palantir Technologies. Palantir has been on a truly phenomenal run.
So today we're doing a deep dive into a pretty significant stack of analyst reports that, frankly, throws a lot of cold water on that momentum.
Mhm.
Our sources are contrasting Palantir with a very different kind of software giant, the German powerhouse, SAP.
And the conflict here is sharp. I mean, it's really stunning. Palantir's shares they skyrocketed. They soared 135% last year in 2025.
Right, all fueled by this AI excitement.
Exactly. And yet, despite that incredible success, the Wall Street consensus for 2026 is that its momentum is going to stall, maybe even reverse a bit.
And then on the other side of that, you have analysts being decidedly bullish about SAP, a company that gets, far less press. They're predicting a potential upside of, 40%.
A potential 40% upside over the next 12 months? It's a classic, really fascinating standoff. How can a business that seems to be doing everything right suddenly fall out of favor with analysts?
Okay, so let's unpack this. Our deep dive today is all about understanding the numbers behind this huge divergence. Why is Wall Street pumping the brakes on the Palantir train, and why are they projecting such a massive potential soar for the less flashy SAP?
Well, as we're going to discover, the answer really boils down to valuation metrics. It's all about how you price future growth today.
It's market euphoria meets fundamental analysis. Okay, let's start with the Palantir phenomenon, because you genuinely can't argue with the performance that drove that 135% surge.
You can't. Their CEO, Alex Karp, he wasn't really exaggerating when he described the revenue growth as otherworldly in a recent shareholder letter.
And what's fascinating, when you dig into these analyst reports, even the skeptical ones, they don't knock the business itself.
No, not at all. There is almost zero complaint about the business fundamentals. The company is winning new customers at an impressive rate, moving way beyond its government work and into the private sector.
And the numbers that back that up are, well, they're monumental. The sources we've looked at consistently point to a metric called the Rule of 40.
Right, the Rule of 40. And for anyone who doesn't follow software as a service companies, it's a key gauge of health.
So it's about balancing growth and profitability.
Exactly. You just add the revenue growth rate percentage to the adjusted profit margin percentage. Most high-growth companies are just hoping to hit 40%. A score of 50 or 60% is considered world-class.
Okay, so what's Palantir's score?
Palantir's Rule of 40 score is 114%.
114.
Yes, that number it's extremely rare. It shows they're not just growing fast, they're doing it with incredible profitability. The sources say it puts the company, and I'm quoting here, in a league of its own.
So if the business is in a league of its own, why isn't Wall Street all aboard? I mean, what are they seeing that everyone else is missing?
It's not so much what they're seeing as what they're calculating. The skepticism comes really almost entirely from the price you have to pay to own a piece of that business.
Okay.
S&P Global recently surveyed 25 analysts who cover Palantir. The results were stark. Only 4 recommended buying the stock.
Only 4 out of 25.
That's right. And the consensus 12-month price target. It reflects a potential upside of only a low single-digit percentage. They're basically signaling that, yes, it's a spectacular business, but the stock price already reflects that, and then some.
That is extremely cautious. So what's the hard math behind that thinking?
The core issue is a metric called the forward price-to-earnings ratio, the forward PE.
Right, so that's looking at the price today versus the expected earnings over the next year.
Exactly. It's a way of asking how many years of future profits are investors paying for right now.
And Palantir's number here is where things get a little wild.
A little wild is an understatement. Palantir's forward earnings multiple is just under 182.
182. Let's just pause on that to put that in context. Across the entire S&P 500.
Only one company has a higher forward earnings multiple, and that's Tesla.
Wow. So paying 182 times earnings?
Mm-hmm.
What does that imply the market is expecting? It must be just flawless perpetual growth, right?
Phenomenal and sustained growth, yes. Traditional value investors, they're used to paying multiples in the teens. Paying 182 is a bet that Palantir will become the dominant global software infrastructure for the next decade. It's really a bet on the company's strategic necessity.
And speaking of that, Palantir's CEO, Alex Karp, he's very aware of this skepticism. He addressed it in his November 2025 shareholder letter.
He did, and his response was, well, it was remarkably aggressive. He suggested that detractors using these old metrics have been left in a kind of deranged and self-destructive befuddlement.
That's strong language to use about the financial community.
It is. He's basically arguing that it's been hard for outsiders to properly value the business because its significance goes way beyond a quarterly report. He talks about its role in shaping geopolitics, its value in the vulgar financial sense.
So he's making a case that Palantir is a unique strategic asset, and that traditional numbers just can't capture its real worth.
Precisely. And that's the tension right there. A CEO who sees his company as essential to global security versus analysts looking at the hard math.
And that hard math right now is leading them away from Palantir and toward SAP.
Exactly. Toward the company analysts actually seem to prefer for 2026.
SAP. The established German ERP software company. It definitely does not get the same AI hype as Palantir,
Right.
at least not in the US market.
Not even close. But the analyst confidence is just, it's worlds apart. That same S&P Global survey looked at 15 analysts covering SAP. 12 of them rated the stock as a buy or a strong buy.
12 out of 15.
And their average 12-month price target is about 40% higher than where the stock is trading right now. It's a huge vote of confidence.
Okay, so what is SAP actually doing in AI to justify this kind of upside?
They're investing heavily, but their approach is more industrial, it's more embedded. The sources say SAP has integrated something they call agentic AI deep into their platform.
Agentic AI. Let's clarify that for a minute. We hear about generative AI all the time, ChatGPT and so on. How is this different?
So generative AI is great at responding to a prompt, right? Write an email, make an image. Agentic AI is about systems that can plan and execute multi-step goals on their own.
So for a big company, that means?
It means the AI doesn't just answer a question. It could say, identify a supply chain failure, figure out the best alternative, renegotiate prices, and then execute that change, all without a person stepping in. It's a total game changer for efficiency.
That puts them right at the operational heart of the biggest companies in the world.
And that's not all. The sources also highlight another key strategic move. SAP operates a sovereign AI cloud for the European Union.
What does that mean, a sovereign cloud?
In a world with GDPR and strict rules about where data can live, it's a massive deal. It means they're the trusted partner for European governments and companies who can't risk their data being governed by US or Chinese cloud providers. It's a huge moat.
Okay, that's critical context. So while Palantir's strategic value is in national security, SAP's is in global enterprise and regulatory compliance.
Exactly. But let's bring it back to the core issue valuation, because this is the real tipping point. We mentioned Palantir's forward PE is almost 182. What does SAP look like?
I'm guessing it's still high, since it's a growth story, but not that high.
Not even in the same ballpark. SAP's forward earnings multiple is 28.5. Now look, 28.5 is not a bargain stock. It's still well above the market average. But compared to 182, it looks a lot less intimidating.
Okay, so here's where it gets really interesting. Because if both PE ratios are high, how do analysts justify buying either one, let alone calling for a 40% gain in SAP? This is where they have to factor in the expected growth.
This is why we have to talk about the price to earnings to growth ratio. The PEG ratio. This might be the single most important metric for looking at stocks like these.
So the PEG ratio tries to reconcile that high PE with the company's future growth path.
It does. You calculate it by dividing the PE ratio by the expected annual earnings growth rate. It essentially tells you how much you're paying for each unit of expected growth.
And the rule of thumb for analysts is that a PEG ratio of 1.0 is sort of the sweet spot, right?
A PEG of 1.0 or below is generally seen as a reasonably attractive valuation. It suggests you're paying a fair price for the growth you expect to get.
Okay, so this is the magic number. What's SAP's PEG ratio?
SAP's PEG ratio is exactly 1.0 right now.
Right on the money.
A textbook reading for a growth stock that's considered fairly priced. Analysts see that and think, okay, we are paying exactly what this growth is worth.
And then we compare that 1.0 for SAP to Palantir's PEG, which I'm guessing is the heart of the problem.
It is. Palantir's PEG ratio comes in at nearly 2.9. The sources are very explicit, noting this ratio is not attractive.
And that difference, 1.0 versus 2.9, that's everything.
Yeah.
Even with Palantir's amazing business performance, the stock has run so far, so fast, that its price-to-growth ratio makes it look almost 3 times more expensive than its growth justifies, especially next to SAP.
That's the key takeaway. The market has already priced in years and years of extraordinary growth for Palantir, maybe too much. SAP, while still priced for growth, seems to have a stock price that's still catching up to its potential. That's where that 40% upside comes from.
So let's look at the outlook for 2026. We know Karp thinks the analysts are just wrong,
Yeah.
that they can't model his company correctly.
And to be fair, the sources concede that Palantir's insane growth probably has made it difficult to assess its intrinsic value. It's a tricky one to model. But based purely on these metrics, the analysis suggests the analysts expecting Palantir's momentum to stall are likely right. The price has just gotten ahead of the earnings.
And for SAP, is that 40% soar a sure thing?
The source material is careful not to guarantee that specific number. Markets are unpredictable. But the overall prediction is strong. SAP shareholders are positioned to have a better year in 2026 than they did in 2025. The underlying valuation, especially that PEG ratio of 1.0, it supports a lot of optimism.
So what does this all mean for you, the listener, trying to navigate these AI stocks? I think the core lesson is pretty clear. While market hype and incredible numbers like that 114% Rule of 40 score are intoxicating.
Valuation metrics like the PEG ratio provide a crucial, really an essential counterbalance. The PEG is your best defense against overpaying for potential. It harmonizes that current price with future growth, which makes it the most powerful tool for comparing these two companies.
And this brings us right back to Alex Karp's provocative comments. The source material notes that Palantir's value is difficult to appraise, both financially and in its significance in shaping our current geopolitics. So this raises a final important question for you to think about. How should an investor weigh a company's deep strategic impact, its irreplaceable government work against rigid financial metrics like the PEG ratio? It's something critical for you to mull over as you track these two very different AI giants in the year ahead.